I think the biggest way it affects Bitcoin is how it affects their Grayscale trust, right? If this allows for redemptions, if this allows for a changing of ownership, if this gets stuck in a bankruptcy court
Right.
for a period of time, I think that's the biggest impact there because GBT is an absolutely massive holder of Bitcoin. But I think it's healthy to go through these cycles and clear out all these malinvestments. It doesn't necessarily mean that I think the bottom's 100% in,
Right.
but I think that it's either in or that we're at least in the later stages of these types of drawdowns for those types of assets. Whereas I'm still quite concerned about it's sort of a haven for scammers, even though of
Yeah.
course there are plenty of people that are doing plenty of interesting things in encryption. There are a lot of serious people in the space, but because it's such a haven, there's so much affinity scamming, there's so much pump and dump schemes. So Bitcoin is historically highly correlated with various liquidity indicators, right? So basically, how much capital is kind of available, liquid for investment. A lot of other investments they trade off things like earnings, they trade off all sorts of other things. Whereas Bitcoin is actually one of the purest liquidity correlations that are out there. And ever since autumn of last year, liquidity conditions have actually been, in many cases, moving up or sideways a little bit. Basically, they declined all throughout 2022. When we got to the end of the year, the dollar index came off of its highs. You started to get Chinese reopening. You started to get, the market pricing in slower forward Fed hiking. Inflation was off of its highs. And I actually think that, Bitcoin probably would have bounced in quarter 4 if not for the whole FTX, implosion. Because you started to see a bounce in a number of risk assets. We saw good movements in precious metals, including ones like silver, that are historically more cyclical. And so I think that basically this is kind of a pent up move from those overall better liquidity conditions. I think the somewhat concerning thing is that you're also seeing a bounce in like meme stocks and unprofitable stocks this year. And so I wouldn't be surprised to see some of this be given back or some of this consolidate for a period of time. But essentially I think that liquidity, at least locally, reached its worst point last year, and at least is kind of a mild improvement. So I think that's going to partially depend on how adamant the Fed is in trying to tighten in the face of decelerating data. I think in most market conditions, this would probably be like a top in the dollar, and we'd see more easing conditions from here. Now, because inflation is still historically high, because Jerome Powell has tied his reputation to getting inflation back down,
Right.
they could be a little bit stickier than they have been in prior cycles. So it's possible that we'll retest this. It's possible that we'll experience more turbulence. But I think this is at least the beginning of a rotation in liquidity, even if it's maybe not the final move. And so I think 25 basis points is probably the most likely scenario. Data between now and then could tweak those odds somewhat. Essentially, what we're seeing is that even though they're intending to continue tightening, they're intending to hold their tightness for longer. We are clearly seeing a deceleration of expectations around how much they're going to tighten, in large part because we've seen a deceleration in inflation and a deceleration in economic activity. So I think 25 basis points is most likely. So in equity markets, a lot of the margin debt has been rolled over, right? So basically, there was, during the big spike into 2021, there's quite a lot of margin debt. A lot of that has been reduced, and obviously, we've seen a lot of debt implosions throughout the whole crypto ecosystem. That was basically debt built on debt in this big intertwined connection. So I think that's actually pretty healthy. I think there's still some pockets of debt. Obviously, we have to see what's going to happen with digital currency group and that full situation there. So it's not like debt has been totally wiped out, and it's never, in recessions, you don't wipe out all debt from any industry. You just kind of wipe out the excessive debt around the margins. And so I do think that it is a much better debt situation than it was before, at least in that market sense, right? So there's still tremendous amounts of debt, for example, sovereign debt, corporate debt, household debt. But in a market sense, basically debt tied to trading assets, that's been significantly reduced. I think the biggest way it affects Bitcoin is how it affects their Grayscale trust, right? If this allows for redemptions, if this allows for a changing of ownership, if this gets stuck in a bankruptcy court for a period of time, I think that's the biggest impact there because GBT is an absolutely massive holder of Bitcoin. More broadly, basically, I mean, they own large amounts of venture positions throughout the crypto ecosystem. Obviously, there are major trading desks. But I think it's healthy to go through these cycles and clear out all these malinvestments, because if you just always go up, of course you're going to get more and more leverage piled up. If you saw an investment that only ever goes up, the rational thing to do would be to leverage, right? If you were sure that it was only going to go up. And so the only way that something can go up structurally is that it has to clear out a lot of that debt every once in a while. And so basically, I think we still have a process to go through. If you look at historical Bitcoin bottoms, they usually, other than the March 2020 event, usually you don't have these V bottoms. Usually you go down, you crash, you capitulate, you go sideways for a while, and you correct both in space and time, and you clear all that out for a while, and then you start to build, right? So I do think that, even though we potentially have seen the lows, I still think there's time to go through before you'd see another just super strong kind of structural rally to new all-time highs. I'm looking at a lot as like the post-dot-com recession, right? That was one where it was a major impact for markets and a smaller impact for the economy. But obviously, it's going to depend on how policymakers handle that. One thing I think is that a lot of people, they fight the last war, right? So they look back, for example, at the 2008 recession, and now they start to fear that every recession is going to be like one of those. One big difference that I point out about this setup compared to that setup is that going into 2008, banks were the weakest they've ever been in terms of they had the smallest allocation they ever had as a percentage of their assets to risk-free assets like treasuries or bank reserves. And they had maximum exposure to loans, to riskier securities, and they had very loose lending standards. I don't think the problem is going to emanate from the banks, right? They're not the epicenter of the crisis in the way that they were in 2008. So this is like the type of recession I think emanates from the periphery and then moves in, rather than say the 2008 crisis that started from the center and then exploded outward from there. So often what I do is rebalance based on conditions. So ever since springtime of 2022, and when the economic data was clearly decelerating and the Fed was clearly intent on causing that deceleration, I basically made the point that you want to be in cash, you want to be in gold, you want to be in defensive value stocks, things like healthcare, things like energy pipelines, things like that. That was kind of like my core position. That type of investment has outperformed, whereas, for example, more cyclical things like Bitcoin have underperformed. A lot of leverage is wiped out. I do think that going forward, some of these cyclical things are getting interesting. So, for example, I've been banging the table a little bit on banks. I think banks are somewhat oversold here. I also do think that Bitcoin is kind of in a deep value zone after so much capitulation. So I'm a lot more constructive on some of these, more volatile type of investments. It doesn't necessarily mean that I think the bottom's 100% in, but I think that it's either in or that we're at least in the later stages of these types of drawdowns for those types of assets. Whereas I'm still quite concerned about, for example, the Teslas and the Apples of the world. I do think that they could have poor, say, 5-year returns compared to, say, something like bank equities or something like Bitcoin that I expect to do better. So overall, I have been emphasizing that mix. Basically, on one hand, you have the conservative cash flow producing assets, and then I do take certain risks in emerging markets or Bitcoin that are historically more volatile, and I'm essentially staying with that position and just leading into things that I think have maybe already had a lot of their downside done. I do recommend that for people that buy Bitcoin, you should try to self-custody it, right? So a broker holding something in like a GBTC or a MicroStrategy is if you have a brokerage, sometimes those are your only options. I do think we should have a spot ETF in the United States, but whenever possible, people should try to self-custody and own their own Bitcoin, which of course I do as well. So I think it depends on what part of the ecosystem you look at, right? So a lot of people focus on, for example, Bitcoin Twitter, which they might mistakenly assume that's all of Bitcoin, whereas of course that's the more vocal public group. Whereas if you look at the developers, a lot of them, they don't have time for Twitter. They're only marginally on Twitter in many cases, and a lot of times they have very different views from the rest of the space. So I think there are pockets of Bitcoin where if you're an intellectually honest person, I mean, you can fit in many different places. I think it's a very inclusive space in that sense. I think the way I would phrase the parts that seem rough around the edges is that on average the community is very open and aggressive about calling out things that they perceive as scams. And I think that unfortunately this ecosystem has been kind of ripe for scams, whereas this technology has allowed for security basically to be sold to the public in a way that goes around a lot of those other historic safeguards. And I think there's a lot of active debate, I mean, whether those safeguards were ever really effective. But because this technology kind of, at least temporarily, in this kind of arbitrage, like regulatory gray zone at the moment, because they kind of go around those, it's sort of a haven for scammers, even though of course there are plenty of people that are doing plenty of interesting things in encryption. There are a lot of serious people in the space, but because it's such a haven, there's so much affinity scamming, there's so much pump and dump schemes and things like that. And so I actually think I do think it's good to pay attention to a lot of the people that might seem closed-minded, because a lot of those have been through multiple cycles and have seen a lot of these before.
Sure.
So I do think you have to balance a little bit, but I do think that it's a reasonable heuristic to have a very, very high bar in this space before you'd consider something investable. I think it's, you want to be open-minded, but you also want to be very, very on the lookout for scams, and kind of start with the assumption that most of the thousands of things out there, unfortunately, are scams.